Imagine this: if two students start a small business, both earn the same money, but one shows profit and the other shows loss. How is that even possible? Same business, same money, but the results are completely different. The reason is not luck. The reason is how they record the transactions. And that depends on something very important: accounting principles. In this video, I will make accounting principles so simple that even if you are learning this for the first time, you will understand everything clearly. No complicated language, no confusion, just simple concepts. Before we start, answer this in the comments. Have you ever felt that accounting is confusing? And if you want concepts to become easy, make sure you subscribe to my channel because that's exactly what we do here. What are accounting principles? Let's not complicate it. Accounting principles are simply the rules for recording transactions properly. Because without rules, everyone would record accounts differently, and then accounting becomes useless. The first accounting principle is business entity principle. You start a small business selling homemade chocolates. You invest rupees 5,000. Now tell me, is that income? No, that is your investment. Now, one day you feel like eating pizza and you take rupees 500 from your business. Is that business expense? No, that is your personal use. So, what's the rule? The rule tells that the business and the owner are separate. Now, be honest. If you had a business, would you mix personal and business expense? Comment yes or no. Next principle is money measurement principle. Let me ask you something. Your teacher says you are a sincere student. Can we record that in accounting? No. Why? Because we can't measure it in money. But if you earn rupees 1000, that is recorded. Simple rule: if it has money value, record it. If it doesn't have, ignore it. I mean, in accounting. Next principle is going concern principle. Imagine this: you buy a laptop for rupees 40,000. Do you think I use it for today? Full money is gone? No, we use it for years. Same in business. We assume business will continue for a long period. That is why we don't treat everything as an immediate expense. Now, let's have a quick check. Are you understanding till here? Type S in the comments. And if you're still watching, you are serious about learning. So hit subscribe. The next principle is accounting period principle. Imagine waiting 10 years to know whether your business has made profit. Impossible, right? So we divide business into time periods, usually 1 year, like your exam results. So we can check performance regularly. The next principle is cost principle. You bought a bike for rupees 70,000. Now its value has become rupees 50,000. But in accounting, its value is still 70,000. Why? Because accounting is not an OLX. We record what we pay, not what people say. Next principle is dual aspect principle. Here's something interesting. Every transaction has two effects. Example, you buy books for rupees 500. Your book increases and your cash decreases. Two sides, just like a seesaw. One goes up and the other goes down. So there's a challenge for you all. Try this. Can you think of any transaction which has only one effect? Comment down. I will be checking your answers. The next principle is realization principle. You sold something for rupees 1000 and your friend says, I'll pay it later. Did you earn income? Yes. So we record it now. So income is recorded when earned, not when cash comes in. So the realization principle focuses only on incomes, that is your revenue. The next principle is matching principle. You earned rupees 5000 from tuition but spent 2000 on your internet and books. If you ignore expenses, you will think you have made a profit of rupees 5000, but the actual profit is rupees 3000. So we match incomes with expenses. So that is the rule of matching principle. And the last principle is accrual principle. It does not depend on when cash is received or paid. Suppose you are taking tuition classes. You taught students in March, but you're receiving fees in the month of April. Now, think carefully. When did you earn that income? In March, right? So, according to the accrual principle, income will be recorded in the month of March, not April. Let's have a quick check. Salary for March is paid in the month of April. In which month it should be recorded? Comment your answer, March or April. So now you can see accounting is not just about numbers. It is logic. It is rules. It is smart thinking. Now tell me in the comments, which principle did you enjoy the most and which one should I explain again? If this video made accounting easier for you, like, share, and subscribe to Commerce Made Easy by Jennifer. Because here we turn confusion into clarity. See you in the next video.